All right, good morning, good morning. Hope you all had a good weekend. I didn't really get as much done as I would have wanted, but isn't that how it goes? Seems like I've always got more on my list. So, like we usually do, we want to take a look around the world, see what's been going on. Keep in mind, Mondays, once we get into the cash session, we're not just getting price discovery for the last 24 hours, we're getting it for the entire weekend, and it's got to price in all of that news. That can often cause that price discovery window to last a little bit longer than it normally would. We got a lot of central bank decisions from around the world happening this week. That seems to be the most talked about thing even here in the market wrap. It's housing numbers today, and there is an additional auction today. And as you can see, European central banks are scheduled to speak through the morning. We were getting a little bit of a move in the dollar, which gave us a chance to rally up off this low, and we did make it back to VWAP. Yay! But that seems to be all we got out of it. So before we go there, though, let's come out to the higher time frame for a moment. The expected move this week, if you do a little bit of rounding, is around $200. Right, 4,000 on the top side, 3,800 on the downside. That seems a little short to me, considering it's an FOMC week. It really seems like they are not doing a really good job of pricing in volatility. And speaking of volatility, another thing worth considering right now is, and I had someone mention this to me over the weekend. If you look at some of the monsters of tech, and you consider what we do when we call a low, or what kind of things we look at when we call a low. One of them that we like is a gapped down recovery with elevated volume. Apple fits that bill, check mark, right? And we've seen this before. I mean, that this recovery day was one of a legendary, absolutely amazing recovery days. Gapped down, elevated volume, rallied back up, but obviously, that wasn't the end of it all. But generally speaking, if you were to go back, when you are trying to call bottoms, even if they're just short-term bottoms, right? Because it's not like we're calling the bottom, but short-term bottoms. A gapped down recovery day on elevated volume is one of the check marks. And it's not in one single name like, oh, well, I seen it in Apple, so it's good. It's got to be all across the monsters of tech, and preferably also in the indexes. So while I can show you that it happened here in Apple, not so much with, say, SPY. I mean, it was higher volume than the previous day, which IBD likes to use that metric quite a bit, but that doesn't account for, say, the ODAM volume that you're looking for, right? It's supposed to be so big and so extreme that you see it and you say, oh, damn, that's a lot of volume. There's another one of those gap down recoveries. Now it didn't even recover, right? It was just a gap down day. Recovery came later. But that's one of the check marks, one of many that we use when we're trying to discern, is this at least a near-term bottom? I don't think so. Microsoft, Amazon, Tesla. And we can find this in a lot of the monsters of tech, but this is only one check mark. One of the other ones is that we've seen exaggerated or overly heavy call option volume. And if you were to analyze the options volume from Friday, we didn't even hit a sizzle at 1, right? Which means it wasn't even getting to its 5-day average, let alone above the 5-day average. So that didn't hit the benchmark. And that pretty much just shuts the whole thing down right there. So when it comes to, saying, was Friday a near-term bottom and are we going to rally up from there? Well, price can do whatever it wants. So I'm not going to say that we can't, but I find it unlikely that it's going to end up being our near-term bottom. All right, volume is a little light this morning compared, say, to Friday, but it's well within range, 116,000 in the overnight cumulative volume. We're within the norm, and that's all we wanted to use that for. Just turn it off now that we've seen it. We are inside day breakout, but it does look like we're trying to get back inside the box. Oh, we are back. Yeah. So we move to the upside right now. We got our own pivot points to fight through. We got to get through that VWAP. The cash open of yesterday at 38.74. The daily pivot point, 38.87. Globex open, 38.89.5. Globex high, call it the roundy, 3,900. And then all of yesterday at 39.05. The previous week's low is also yesterday's low. So that 38.53 right now is a pivotal level. We did get below it, but we had that 2-bar reversal and came back up, and well, we'll see, right? When it comes to a double bottom, it's actually more like a triple bottom, but using bigger time frames. When it comes to this double bottom, the fact that we went lower than that previous low is kind of a good thing. The way that IBD likes to lay this theory out is when we do break down, shorts are jumping in, and longs are, anybody who tried to play the bounce up are getting squeezed. So the longs puke out, which adds to the selling, which causes us to get just a little bit deeper. And then they flip the script on the sellers, run it back up, squeeze those sellers. And what you usually end up with is this area where those shorts just can't handle it anymore. And you get like a top side of like a blow off top. Or I heard someone say once a liquidation break to the upside, which doesn't necessarily exist in technical analysis, but visually that's exactly what it looks like. Generally, I'd be looking for it around here. It tends to be, the final extremity of what it can and can't handle. That VWAP zone, though, kind of makes me believe that if we were going to see that and the squeeze was going to cause those shorts to capitulate, and have to buy back. It's very likely going to happen around that VWAP, since this area is just so deep. There's really not a lot on the docket today, other than the fact that we do have those additional auctions. Those can absolutely be a game changer. So watch the clock on those auctions. I know they don't get a lot of fanfare or attention. I seem to be the only one that ever talks about them. But on days that we have them, I absolutely watch for the market to change from whatever it was doing and do something completely different. If we've been range bound, I expect it to break out. If we've been trending, I expect it to die or flip and go exactly the other direction. I expect an absolute change of structure. And if nothing happens, fine, nothing happens, but at least I'm ready for it. All right, looking at the 10-day, 30-minute volume profile. We do have some of our own volume around this level, and it's from Friday. It's a significant amount. It's over our head. It's going to be a fight to get back through this level. If we can get above 3880, we start to get into a little bit of a shallow zone. It's not amazing. But one thing that stands out about that 3880 or that 3900 area is generally we would look at this and we would think, ooh, pivot point, 3900. And we would anticipate some form of resistance when we get there. That's actually in a very shallow area, comparatively speaking, with everything else that's going on. So don't expect that high, that 3900 roundy, to be as much resistance as you think it is. Of course, the right now volume, as you run up into that zone, watch the dome, look at the ticker, look at the tape speed, and see if anybody's defending that level, and then we start building volume at that area, right? We don't have none right now. These volume nodes, there aren't a lot of volume there. But that doesn't mean that there won't be defenders, and it doesn't mean that there won't be liquidity at that area that could turn into a resistance. But right now, volume-wise, we don't have anything there to really focus on. Once we get through that shallow area, that's when things really start to tighten up. So if we do get above it, expect it to turn into our support, and we're going to need it because with all this trash overhead, it's going to very likely have to pull back and then continue to fight to get that move to the upside. I don't see a move to the upside this week until Powell, but we certainly want to talk it out, right? And I shouldn't have said it that way. I don't see the market doing much of anything this week until Powell. And if he causes the market to go up, then that's when I would expect to see it, is during his FOMC announcement. I think he's going to want to do exactly what he did at Jackson Hole. He was scheduled to speak for like 30 minutes. He talked for 8. Right? He tried to remove any doubt, any ambiguity, clear up the muddy water. He tried to get the message across that we're going higher in rates and we're going to hold them there longer than you guys keep thinking we're going to. Right? It was very hawkish. I think he's going to try to give that same boot stomping, slap the table message that he did then. And if he does use that hawkish tone, it won't matter if we raise by 75 or raise by 100, which is kind of on the table. It'll matter that his tone and his implication that the pivot is not going to happen in 2023 the way everybody's pricing it in, and that it's possibly going to happen in 2024, and we break 38.50 to the downside, and we start heading towards, say, 36.50, 37 flat. That's kind of what I'm looking for. Now, he turns into a little prince with doves and, butterflies, sunshine, and rainbows. Then, yeah, 441, well within range, easily attainable. So what it comes down to in that rant is that we're very likely going to maintain a range for the week. We have the expected move high, we have the expected move low between 41 flat, or excuse me, between 4,000 and 3,800. I don't think we're going to use it all, but we could definitely wick through, the value area high, value area low, make this range slowly widen out. Lots of chop, lots of sideways structure while the market waits on Powell. Every day, I keep track of market on close. And we've been doing this, close to 2 years now. Every single day, we come in after the close, and we get the stock imbalance report from Market Chameleon. On Friday, we've seen some really big numbers. Now, if you don't look at this every day, these numbers aren't going to really help you out that much. But look at this. I look at this every single day. That's a big rotation kicking off right there. Longs are getting closed. Shorts are getting closed. I used to think that this was a bit of a rotation, right? That they were getting out of something and then also getting into something. And this is not the first time we've seen this level, this 500 on each side. But it's not a rotation, it's kind of going to flat. So they're getting out of positions, which makes sense because they want to hear from Powell, and then they're going to load into some new positions. The cool thing is there are names that you can go through. You can run the scanner and kind of look through it and see, what was traded. This is not a free website. I'm not logged in, so what we're looking at right here, this is free. But if you wanted to perform research on this data, you got to pay for it. And I don't know. I've always said that if it's not really worth it if this is all you're going to do. This website has a lot of other really cool stuff. But if you're not using the full website, it's not really worth the $50 or $60 a month to get the subscription. If this is all you want, just stay with the free stuff, right? So this is a little bit of a tell, a little bit of a heads up. I don't expect a lot out of this market until FOMC. And I know traders who don't trade during the FOMC week. They just call it quits. This is their time off, and they go do something else. Just to kind of save them from any kind of FOMO and trying to participate in what's very likely going to be a lot of chop and a difficult market. I'm not going to do that myself, but it's not a bad idea. Something to keep in mind. We're not going to go through the stock list. I don't expect a lot of the stocks to offer much opportunity. They're going to do a lot of what the rest of the market is doing. This morning, the dollar had this really nice breakdown. And in that breakdown, the S&P had that run to the VWAP. That's my day done right there. I'm already done for the day, and that's where I got it. So I'm not looking for any trades. I made it with that liquidation drop in the dollar. The VWAP continues to be, not VWAP, the VIX futures, or the VIX itself continues to be a little sloppy. It's not quite doing its job as good as we would like it to. The volatility within the volatility index the VVIX that is picking up a little bit. So it looked like we were going to start getting some real volume or some real activity here in the VIX, and then it just came right back in again. For the amount of chaos and the amount of really just absolutely extreme moves that we've been seeing in the rest of the market, I would expect more out of the VIX than what we're getting. When I was going through looking at some things on Friday, there were actually VIX products like the VIX 9 that closed down on the day, right? So we had the S&P, the NASDAQ making extreme moves, and the volatility measures closed lower on the day. That's how crazy and nuts things are right now, and how little the VIX is actually helping out. We don't want to use the 2-day. Want to step back some, at least into the October series, the active October, or the most, yeah, I would say active. That's a good word for it. It's 2787. So we get out of October, start getting into November. It's 28. Then December and January, also 28, but at a higher number. So we're still in contango. It's just really, really flat. If we slip back into backwardation, we're liable to see some, maybe we actually get a little bit of fireworks. So this is what we're talking about when we talk about how things are starting to look flat. We want it to be this gentle curve from low to high. All right, we got price here on the right, and we got time along the bottom. Close in time should be cheap, far out in time should be more expensive, and as you travel through time, things should get more expensive. I mean, that's Contango 101. The concern is, here like with April and May, when it starts to point down, when something closer is more expensive than something farther away, that gets us into backwardation. So we've got it in January and February. We've got it in April and May. Those aren't really too big of a deal. They're far enough out there. They're not going to mess with your options. It's these ones in the front, and especially say right here with November and December. Now, obviously there's a big disconnect going on with the January series. Notice how all of those are just sitting up there kind of doing their own thing. It's these down here, October, November, and December, that are our main concern right now. Watch that October series. If it crosses November, it's very likely going to be above November and December at the same time. If we start to see all three of these making that move to the upside, then $29 is the line in the sand. So as you're watching those VIX products, $29 right now, even 28.5. I don't like 28.5. $29 is the line in the sand. You start seeing the VIX, the VIX, get above $29, you're going to see the S&P start breaking down below, say, 37.5 or 38. $37.5, not 38. We will very likely retest these lows if we see that VIX above that 29 level. All right, so we got a benchmark. It's a little bit of a line in the sand. It's correlated markets out there. So watch the dollar, watch the bonds, watch the VIX. There's so many VIX products. Try to pick one you understand. Right? Like just plain old everyday VIX. Certainly nothing wrong with it. I like to use the VIX futures, but hey, whatever works, right? If you start getting into those really odd, kind of complex volatility products, do some research on it, do some homework on it so you understand what it's actually looking at and where its design metrics come from. Where does its numbers come in? That's what I got for you guys. Be careful, be safe. I will see you all tomorrow.